Hey, welcome back. Are you ready to sell, but the closing date on your new home doesn't align with the sale of your current home? Or maybe you haven't sold your home. I'm Justin Chaussee, your friend in the mortgage business, and today we'll discuss the different scenarios when you might use bridge financing and the different fees and how they'll vary. So grab a cup of coffee, sit back, and let's get started. But before we get into it, please press the subscribe button, smash the notification bell so that you can continue to get more real estate tips. Bridge financing is a short-term loan designed to bridge the gap between the purchase of your new home and the sale of your current one. But did you know the different scenarios when you might need bridge financing? Each has its own set of fees and costs. Today we'll be covering the three main situations. Your current home is sold firm, meaning there's no other conditions and you're waiting for the house to close. Your house is listed but not sold. Your house is not listed and you've purchased a home. In the first scenario, your current home is sold firm. This is a traditional way and traditional type of bridge financing, which means you've gotten a binding agreement with the buyer and all the conditions have been met. This is the most common situation for bridge financing, and the fees in this case are usually the most straightforward. Number one, interest. You'll be charged interest on a bridge loan typically at a higher rate than a standard mortgage. The interest is calculated on a daily basis. So the longer your bridge period, the more you'll pay. In a lot of scenarios, we're looking at less than a month to do this. The second set of fees is going to be any administrative fees. Lenders will charge an administrative fee for setting up the bridge loan. This fee can vary depending on the lender, the complexity, and the length that you're taking the bridge loan for. Number two, your house is listed but not sold. Your house is listed on the market, but it hasn't sold yet. This situation can be a little bit trickier, as lenders may view this as higher risk. As a result, the fees in this scenario might be different. The interest rate will be higher than in scenario one, as the lender is taking on more risk. Administrative fees. The lender might charge a higher administrative fee due to the increased risk involved as well. Additional fees. Some lenders might require you to obtain a home equity line of credit or a HELOC as a backup, which could come with its own set of setup fees. In the third scenario, your home isn't even listed on the market yet. This situation is less common for bridge financing. It's considered even more riskier for the lender. In a lot of cases, they are done privately with a private lender. The fees in this case could be significantly higher. The interest rate will likely be much higher than all the other scenarios due to the increased risk. Administration fees. Once again, you can expect a higher administration fees as well. Additional fees. The lender might require additional collateral or guarantee, securing against the additional properties, which again will come at a fee to do so. If you are looking to buy or sell or need help with a bridge loan, give me a call, shoot me a text, or go to chausseemortgages.com and book directly in my calendar, and I promise that my team and my preferred partners will give you the local competitive advantage in today's real estate market.